It's that time of the year. Your vacation is coming up. You can already hear the beach waves, feel the warm breeze, relax, and think about work. You really, really want it all to work out while you're away. Monday.com gives you and the team that peace of mind. When all work is on one platform and everyone's in sync, things just flow. Wherever you are, tap the banner to go to Monday.com.
Welcome back to another episode of Investies. I'm your host, Linda Garcia. This week on the podcast, we are going to take a look at how July performed, key data that was released in July. We also heard from Fed Chair Powell. We're going to discuss his decision on rate hikes and the potential of a rate drop in September. We're also going to look at a report that was recently released on key data for inflation city by city. And we're also going to look at unemployment rates state by state. But before we get into that, I did want to share that I was recently on the Unicorn Millionaire podcast with Charlie. This is such a great podcast with practical information. We did an episode on how to take advantage of capitalism, but they have really great practical day-to-day financial advice, like how HSAs can help you retire early, Chase Sapphire Preferred credit card versus the Sapphire Reserve credit card, how to handle large cash influxes. I highly recommend that you head over to Unicorn Millionaire Charlie's podcast. If you like this podcast, you'll enjoy Charlie's podcast. I also wanted to give a shout out to Francesca Martinez, a new subscriber to our Patreon. Thank you so much, Francesca, for your support. It means so much to me and the team. If you want to support Investies podcast, head over to Patreon /Investies, where you can contribute $3 a month. You get the podcast early. You also get a shout out on an episode. You're helping us with our expenses. We are self-funded. We appreciate your contribution. Several months ago on Investies, we talked about how I felt that inflation was going to start to come down dramatically. And part of the reason why I felt this way was because of the earnings that were being released back in Q1. If you remember, I highlighted certain brands that were aggressively working on bringing down prices, like Walmart, Target, fast food chains. And just as predicted, we are now seeing the results of those prices coming down in our inflation data. I made this prediction in an episode released on May 24th titled Breaking Down Target's and Walmart's Earnings Calls. We will be sure to link that episode in the show notes. In case you haven't heard that episode yet, I definitely recommend that you go over and check out that episode. Now, I do want to have a conversation about this because I think it is important. I have been carefully listening to earnings calls from retailers and restaurants, and sometimes even travel, not as much as I do retail, because I think that that is the number one indicator of where we are at financially. And what I find interesting about this is that I do use retail earnings calls as a sort of barometer as to where we could potentially be headed with the economy. I feel like this information is closer to real time in what is happening with a consumer. And the consumer is the number one indicator of how we are performing in the economy. I do find it really interesting that I don't hear about analysts using this data to tell us where we are headed. There might be analysts out there that use this data. I've just never seen it. It's something that I've always done intuitively, because when we are looking at GDP when we're looking at unemployment rates, when we're looking at CPI to tell us how inflation is performing, we are looking at data from the rear view mirror. It is not forward looking. We are looking at data that took place a month, 2 months, a quarter behind. It's challenging to drive a car looking at solely the rear view mirror. The earnings report for retailers in this earnings season that we are currently in right now has not yet been released. It won't be released until mid to late August. So I don't have those numbers for us to reflect on in terms of how Target and Walmart and some of the grocery stores are performing. But what we do have that I think is important for us to take a look at is McDonald's earnings. They missed their earnings and their revenue. Back in May and June, when we were having these conversations of companies lowering their prices, McDonald's was also one of the companies we talked about. And it's important for us to take note that back then, McDonald's had an aggressive plan to create a $5 value meal in order to attract customers, a telltale sign that the company was pretty much in trouble. And so it was really no surprise to us that their earnings per share was missed, and so was their revenue. Earnings per share came in at $2.97 versus the $3.07 that Wall Street was expecting. Now, just as a reminder, earnings per share is the calculation of profit. We calculate the profit per share because we aren't sole owners of a publicly traded company. We own shares. And so this way we can calculate ourselves. If we own 10 shares of McDonald's, then we can calculate how much that profit is for the amount of shares that we own as individuals. The revenue is calculated in its entirety. We don't break it up per share because that is irrelevant. It is the money that is coming in from sales, not yet accounted for any costs or expenses. So McDonald's brought in revenue of $6.49 billion versus $6.61 billion that Wall Street was expecting. So both earnings per share and revenue was a miss for McDonald's. Something that's really important for me to note is that McDonald's originally intended for this $5 value meal to last until the end of July. However, with their continued miss on earnings and revenue, they have made the decision to extend the $5 value meal into the future. They really didn't mention how long. I think they're going to take it maybe month per month to see how it continues to perform. They did see that the value meal did increase some traffic. And so this is some positive news for McDonald's that their strategy on lowering prices, which really isn't that, intelligent of a strategy. It is pretty obvious, most especially with the type of economy that we are currently facing. It makes sense that people are coming into McDonald's and starting to spend money. And so what they are noting is that they need to have this value meal in place for a longer period of time. We heard from Fed Chair Powell on his decision on maintaining interest rates where they are. So we are not decreasing interest rates right now. We are not increasing interest rates. We are going to continue to hold. There is no surprise there, given that the biggest Wall Street anticipation is potentially a September rate cut. Now, when Fed Chair Powell and his team are looking at the consideration of lowering or increasing rates, they are mainly looking at three different data points. They're looking at unemployment, inflation, and our GDP growth. I also want to be very clear that when Fed Chair Powell and his team are making this decision, he has said over and over that he is not data point dependent, but he is data dependent. This means that he doesn't have a specific target that he wants to hit in unemployment, in inflation, or in GDP. He just wants to assess the data as a whole and then determine whether a rate drop is feasible at that point in time. You all have heard me say over and over that I am not anticipating a rate cut in 2024. I am anticipating a rate cut to take place in the first half of 2025. I just feel that this inflation has been pretty significant. To start cutting rates so soon, I think would be a big mistake from the Federal Reserve. So I understand that they want to proceed with caution. Now, it's important for me to highlight, as I've highlighted in the past, my speculation on what is going to take place is not coming from being psychic or looking into a crystal ball. It is me just looking at all of the data that I have at hand. And based on that, I am making a speculation, which means I can be completely wrong, most especially given that we are seeing the significant effects on lowering prices from Target, Walmart, McDonald's, and many other places that are trying to stay competitive. We're seeing that already impact our CPI data. We've talked about CPI many times on this podcast, but as a quick reminder, it is the Consumer Price Index. This measures the change in prices of goods and services. So it measures it month over month in terms of what prices have increased or decreased. We have definitely seen a significant change in the last 2 months. I think this is important. We are looking at the effects of companies lowering their prices. Last month in July, our CPI data came in at a negative 0.1%. In June, it came in at 0% change. And in May, it came in at 0.3%, April 0.4%. So we can definitely see that it is significantly decreasing. Let's not forget that we're already in August. And so next month in September, to be able to make a decision so fast, even if we have continued signals that inflation is under control, I feel it is too short of a time period to start cutting rates. We've had inflation as an issue for the last 3 years. And so to take a few months to make that decision, I think would be a mistake. That's just my personal perspective. And so please take that with a grain of salt. We will see where we actually land on his decision. Now, it's important for me to bring up another point. We cannot forget that we are in an election year. It's important for us to understand that the President of the United States is the person that nominates who the Fed chair will be for the 4-year term. And so every time that there is a new presidential term, there is an opportunity for someone else to be appointed as the chair of the Federal Reserve. Fed Chair Powell was first nominated by President Trump. President Biden decided to keep Fed Chair Powell on during his term. And so we could potentially see another person at the helm of the Federal Reserve. And so there is a little bit of conflict of interest here. And there's always speculative chatter on Wall Street that whoever is the Federal Reserve chairman or chairwoman, they are speculated to manipulate what happens during an election year to favor the president that is sitting. They are speculated to manipulate what happens during an election year to favor the sitting president. Given that the president that they may be favoring was most likely the president that brought them in. However, we have a very unique situation with Fed Chair Powell. Since former President Trump brought him in, President Biden kept him on, there may not be market manipulation. And to be completely transparent with you all, I've just spent a lot of time observing Fed Chair Powell, observing his demeanor, his form of communication, and he just doesn't strike me as a person that even has the guts to manipulate the market. He has been called out by President Trump, warning him that he should not drop interest rates in September because he would be manipulating the market. Despite the fact that when Trump ran against President Joe Biden, he was dropping interest rates. However, given that we were going through a global crisis like COVID and every single tool possible, including stimmy checks, were being poured out into our economy, there was really no choice but to lower interest rates to start stimulating the economy in this way. I don't know necessarily that any of us saw it as market manipulation, and maybe I'm being completely naive because we were in the midst of such chaos. But I do think it's very interesting and worth noting that it was okay for Fed Chair Powell to lower interest rates as aggressively as he did during an election year while Trump was the sitting president, and how now he's calling out this behavior that it is not okay for Fed Chair Powell to lower interest rates during an election year while Biden is a sitting president. The hypocrisy, I think, needs to definitely be called out. That statement from Trump was brought up directly by a reporter to Fed Chair Powell during the conference this week, and Fed Chair Powell defended that he is a non-political agency and that decisions will not be based on politics, that he's looking at all of the data points and making sure that he's making the proper decision based on those data points. We'll wait and see what happens. Again, my stance is the same. I think that a rate cut in September is way too early, given that we have had very high inflation for several years now. And just so we're clear on why I feel so strongly about this is because I am looking at this from a perspective of marginalized community members, of low-income communities, in that inflation is affecting them the most. And they are the ones that, as an economy, we need to take into consideration. Otherwise, we are driving up homeless population and getting into more issues when we forget about our lower income communities. Does this affect me of not lowering interest rates? Of course it does. It affects me because I'm part of the middle class, and this prevents me from increasing my generational wealth at this time. But I think it's important for us to strongly consider lower income communities and that they are the ones that we should be taking care of first and foremost. And it's not going to be a huge detriment to me to not have access to lower interest rates in 2024 than at the beginning of 2025. Something really important that I want to also add to this conversation is that when we are looking at unemployment numbers, when we're looking at inflation and we're looking at GDP, we are actually looking at the average across the United States of America. And when we're looking at individual cities or individual states, these numbers change drastically. I want to share a recent report by Wallet Hub on cities with the biggest inflation problems. And the numbers on how high inflation has grown changes drastically. We're not looking at a negative number, or we're not looking at a 0.0 unchanged number in CPI. We're actually looking at impact. The report itself, we will link in the show notes so you can take a look at all of the cities impacted. I'm just going to name the top 10. Coming in at number 10, we have San Diego and Carlsbad, California, where we saw CPI change 0.5%. And if we compare that number to last year, we're looking at 3.2% increase. Coming in at number 9, we have Seattle, Tacoma, Washington. That number just month over month is 0.4% versus a year ago at 3.8%. Coming in at number 8 is the cities of Washington, Arlington, and Alexandria with a 0.8% increase, and year over year, 3.3% increase. St. Louis, Missouri came in at number 7 with 0.8% increase month over month and 3.4% increase year over year. Coming in at number 5 is Riverside, San Bernardino, and Ontario with a 0.6% increase month over month and a 4% increase year over year. Boston, Cambridge, and Newton came in at number 5 with a 0.6% month-to-month increase and a 4% increase year over year. Number 4 is Detroit, Warren, and Dearborn with a 1% increase, 3.4% increase year over year. Coming in at number 3 was New York, Jersey City at 1.1% month over month increase and a 4.2% year over year. Coming in at number 2 is Honolulu with a 0.7% month over month and 5.2% year over year. And coming in at number 1 with the most impact on inflation is Dallas, Fort Worth, and Arlington at 1% increase month over month and 5% increase year over year. And so you can see that those numbers are not at all indicative of the average that we have experienced, which was a negative 0.1% month over month. And so again, this just speaks to the experience of what we're feeling in big cities as opposed to what is taking place on average across the country. You're listening to Investies Podcasts, a Cosmic Standard and In Luz We Trust production. I'm your host, Linda Garcia. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.